interest-bearing accounts. Applying another recommendation, you will soon realize a ninth additional stream of income in the form of interest earned. Can you just use your 8 additional streams of income to start enjoying life more now? You could misuse your newly found wealth generating power in the form of those 8 additional streams of income to improve your present lifestyle temporarily, but you have already learned how to live on the net income you were earning before applying the recommendations. Besides, if you were like most people, you have not established the kind of account or funded it with a sufficient amount of money that will provide an annual 6-figure tax-free interest income for the rest of your life. Applying the recommendations facilitates just that. So, recycle your 8 additional streams of income into maximum funding for at least one new permanently risk-free tax-free compound interest-bearing wealth account and live on the 9th additional stream of income, an annual 6-figure tax-free interest income for the rest of your life. In a January 2005 Oval Office meeting with Social Security Administration trustees, U.S. President George W. Bush advocated this very strategy when he recommended allowing young people to use their taxes to generate their own wealth and income as part of a comprehensive solution to the Social Security issue. Read the short yellow highlighted sentence on page 1 of the meeting transcript accompanying this session. There is still another, a fourth, synergy between generating additional streams of income and funding at least one new permanently risk-free tax-free compound interest-bearing retirement account, in that consistent accumulation of wealth is affordable by using the additional streams of income as funding, and your wealth-generating efforts are accelerated by doing so. What if you already have a tax-deferred account? Great. Do not cancel it. Just let it ride. If it is a 401k, you cannot beat the free money from your company. So do not let go of it unless you are the company, or you own the company, and you want to start funding a better program. What is the difference between a tax-deferred retirement wealth account and a permanently risk-free tax-free compound interest-bearing wealth account? Tax-deferred accounts, also commonly called qualified accounts, since they are qualified for deferred taxation, provide an upfront tax benefit. That is, contributions are made before tax, and current taxes are calculated on only some income, the after-contribution portion of earnings. Contributions grow with interest on a tax-deferred basis, are subject to annual limits, pre-age 59.5 distribution tax penalties, and minimum distribution requirements that distributions must begin within 6 months of retirement or not later than age 72, whichever comes first, and are reported annually to the IRS and taxed upon distribution. The theory behind tax-deferred retirement wealth accounts is that you will pay taxes at rates that are lower when you are retired than while you are working, and that hence actual tax cost is reduced by paying taxes later rather than earlier. However, you bear the risk that your income will in fact be greater in retirement, so that you will in fact pay a higher tax cost than you would have if you had paid taxes on all rather than only some of your income while you were still working. With a tax-deferred wealth account, you are betting you will not pay higher taxes later, and the government is betting you will. Why do you suppose the government makes that bet with you? Either way, due to income ceilings, annual contribution limits, and excess contribution tax penalties, the typical individual is not able to generate an annual 6-figure income from a tax-deferred retirement wealth account. In fact, the individual would need to use several different such accounts to accumulate a large enough aggregate amount to generate an annual 6-figure after-tax retirement income. An impossible feat given tax-deferred retirement account contribution restrictions. Determination of the right vehicle. So what is the right vehicle that gives you more options and better features and benefits, and even gets better government treatment than even the best bank savings or direct investment plan? Revisit the tax and interest workbook accompanying the second session and refer to the information on tabs 12, 11, and 10 as each category of retirement vehicle is explained. Also refer to the document accompanying the second session for retirement vehicle contribution limits. As this course has demonstrated, particularly by means of the tax and interest PowerPoint audio presentation and workbook, implementing all 5 steps for observing all 3 principles in combination for achieving financial prosperity, namely avoidance of taxation, efficient application of the Rule of 72, and avoidance of market losses, is the most effective strategy for accumulating the greatest possible wealth and income. Retirement vehicles commonly provided through employers may be established with little forethought or planning and funded by means of very convenient employee payroll deductions. Such vehicles are tax deferred. The issue is not whether they will be taxed, but when. So they do not enjoy avoidance of taxation. Such vehicles are subject to annual contribution limits, excess contribution tax penalties, early and late distribution tax penalties, and minimum distribution requirements. The issue is also not just the restriction on your savings contributions, but also the corresponding restriction on your growth potential and future distributions. Such vehicles also do not provide any umbrella of coverage against financial losses due to poor health, may or may not be subject to inflation risk and the corresponding limited growth potential, and may or may not enjoy either the best available interest or the highest available interest. So they may or may not enjoy efficient application of the Rule of 72 and avoidance of market risk. Finally, and you deserve credit if this does not apply to you, people tend to set it and forget it with such vehicles, which means that you must first fund such vehicles with your dollars after you request your employer to deduct and make the contributions in your behalf. And if you can find another employer to administer your contributions to the same fund if you later decide to change employers. Although the initial convenience of tax-deferred vehicles, as well as their various other features and benefits, makes them appear very attractive, the reality of taxation and contribution restrictions makes them an unsuitable means of observing all 3 principles for achieving financial prosperity. Some retirement savings is better than no retirement savings at all, but you can do much, much better. Direct investments may be funded with diverted tax dollars rather than your dollars. Do not provide any umbrella of coverage against financial losses due to poor health. Are not subject to annual contribution limits or early or late distribution tax penalties or minimum distribution requirements. May or may not be tax advantaged. May or may not be subject to inflation risk and the corresponding limited growth potential. And may or may not enjoy either the best available interest or the highest available interest. So they may or may not enjoy avoidance of taxation, efficient application of the Rule of 72, or avoidance of market risk. Although the various features and benefits of direct investments make them appear very attractive, the reality of at least 2 of 3 categories of risk makes them an unsuitable means of observing all 3 principles for achieving financial prosperity. Annuities may be funded with diverted tax dollars rather than your dollars. Do not provide any umbrella of coverage against financial losses due to poor health. May or may not be subject to annual contribution limits and excess contribution tax penalties, or early or late distribution tax penalties or minimum distribution requirements. May or may not be tax advantaged, and may or may not enjoy either the best available interest or the highest available interest. So they may or may not enjoy avoidance of taxation, efficient application of the Rule of 72, or avoidance of market risk. A basic annuity has no contribution limits, but it also does not enjoy avoidance of taxation. A Roth IRA, a hybrid with the tax-free potential of a cash value life insurance contract, but the other restrictions of a traditional IRA, is an annuity with maximum income-based contribution limitations and the corresponding limited growth potential, as well as early distribution tax penalties. Accordingly, the reality of contribution restrictions makes a Roth IRA, or even an index Roth IRA annuity, a distant second most effective means of observing all three principles in combination for achieving financial prosperity. Cash value or permanent life insurance may be funded with diverted tax dollars rather than your dollars. Provides an umbrella of coverage against financial losses due to poor health. Is subject to customizable, temporary annual contribution limits. Is not subject to early or late distribution tax penalties or minimum distribution requirements. May or may not be subject to inflation risk and the corresponding limited growth potential. May or may not enjoy either the best available interest or the highest available interest. And as long as there are no excess contributions during the first 7 years, and as long as the policy is not canceled or allowed to lapse, is not subject to taxation. So it enjoys avoidance of taxation and may or may not enjoy efficient application of the Rule of 72 or avoidance of market risk. Whole life and universal life insurance bear fixed interest with the corresponding inflation risk and limited growth potential. And variable universal life or VUL insurance bear variable or the highest available interest with the corresponding market risk and unlimited but also uncertain growth potential. However, index universal life or IUL insurance bears index or indexed interest and thus enjoys avoidance of market risk by means of performance guarantees, both a minimum stated growth rate of anything at or above, but never below, 0, and participation in only the upward movements of the market and never the downward movements of the market. Thus, an IUL contract enjoys the best available interest, so it also enjoys efficient application of the Rule of 72. Accordingly, the reality of customizable, only temporary annual contribution limits, along with avoidance of taxation, efficient application of the Rule of 72, and avoidance of market losses, makes an IUL by far the most effective means of observing all three principles in combination for achieving financial prosperity.